Hello, Paul McFadden here. So let's talk about getting your investment criteria right when it comes to a buy to hold strategy. One of the biggest challenges I see for people who are thinking about getting started in property, or maybe they've already got started, but they've not yet got to a stage where they're making quick decisions when it comes to investing in property. Mainly it's down to two things. One, not doing the right due diligence, which we'll touch on and talk about in future videos and podcasts. And two, they're maybe just second guessing the numbers, whether it's going to be a good deal to add to their portfolio or not. So you've probably heard the terms is that it's got to have a good yield, gross or net yield at a certain percentage. Well, I want to step that aside for a second and just focus on an actual figure. Because when we talk about your investment criteria when it comes to a buy to hold strategy, because there's a number of different buy to hold strategies, from buy to lets, traditional. You've got HMOs, house of multiple occupation, service accommodations. There's three core buy to hold strategies. Each are very different in terms of their target market and who's going to be the tenant. From a buy to hold, it's going to be a single family, one tenancy agreement. For a HMO, it's going to be renting out each of the rooms, so it's going to be individual tenancies on the one property. And then you've got a service accommodation, which is short term, normally holiday lets and so forth. So when we look at whatever your buy to hold strategy is, for every £100,000 of value that property is, you want to make sure that you're making a minimum of £250 net positive cash flow after all expenses. So net is after all monthly expenses. So for example, let's say you've got a property that's worth £100,000. Let's say the rent on that property that you can achieve as a single buy to let is, let's say, £650. Just making up a number here. And let's say once you deduct the mortgage interest payment, let's say you deduct the building insurance and the management fee for the letting agent, whatever's left over, you want to see more than £250. Now there's going to be this argument, well, what about voids, what about maintenance, what about tax and all that kind of stuff? Yes, all that is something you need to factor in with running the business, but I'm looking at each property in its own individual basis here. And this is the three things you want to factor in when it comes to deducting expenses from the monthly rent, which is, let me repeat again, is the mortgage interest payment, it's going to be the letting agent fee, and it's going to be the building insurance. So if it's got £250 net after you've paid those three things off from the monthly rent, then it's a good deal. That's what you're looking for. So it means if it's a £200,000 value of property, once you pay off the monthly expenses, the three things that I've just mentioned, you're going to be looking for £500 net positive cash flow. If it's a £300,000 home, you're going to be looking for £750 net, £250 per £100,000 of value. Then you'll never need to worry about the yield, because this here is a great yield, a great property that you would want to consider adding to your portfolio, providing it ticks the second box, which is money out of the deal. So when we are investing in a property to hold, a buy to let or whatever buy to hold strategy, you want to make sure that you're buying for cash flow. And secondly, you want to make sure that you're pulling your money out when you refinance after 6 months. Now, a rule of thumb here is you've got to look at how long are you prepared to leave your money in a property. This is forcing you to buy right in the first place by buying at discount and add value, because you're going to have to put money into the property to buy. You're going to have to put in the deposit, you're going to have to put in the renovation cost, the stamp duty and any associated purchasing costs like legals and so forth. Let's say it's a £100,000 home, just keeping it simple here, and you have to put £40,000 in, which is made up for the deposit, the refurb and associated purchasing costs. And after 6 months you've added value to the property, then you refinance up to the new value, and let's say you get £38,000 back out. You put 40 in to buy, you get 38 out once you refinance, you've left £2,000 in the deal. That's what you've got at risk here. But if you've got £250 net positive cash flow, then it's going to take you 8 months of £250 net positive cash flow coming in from the rent to make sure that you've got your £2,000 out of that deal. So in month 9, you're making an infinite return on your investment, because all of the money that you invested into that property is back out. So we talk about ticking the second box. when it comes to buy to hold strategy, my recommendation is you want to buy property where you get all your money out inside of 12 months from when you buy the property. Now again, you can extend that to 24 months or longer, but understand the longer the term, it means more capital is at risk, your capital that you put into the deal. Now, if you've got lots of money to keep on buying property, you might want to extend the time frame that you leave some money in because you're happy with that. But if you've got limited funds, then you need to be refinancing and pulling that money out in a short period of time so you can go for property number 2, 3, and so forth. So again, to summarise here, you're looking for £250 net positive cash flow after you deduct the mortgage interest payment, after you deduct the letting agent fee and the building insurance, where you've got £250 net positive cash flow per £100,000 of value, and you want to really try your best to buy right in the first place, buying at discount, adding value, so when you refinance, you're pulling all your money out that you invested into that property inside a 12-month period. Now, what I recommend you do, if you're interested to get started in property, or maybe you're already involved in property, but you're looking to accelerate your existing property business, then head over to propertyprotege.com and see how we can help you with that. Also, make sure you're subscribed wherever you're watching this, whether it's YouTube or on the podcast player, make sure you're subscribed to this. But more importantly, if you think there's anyone that could hear this, that you could recommend and maybe share it with it, maybe share this with 1 or 2 people to spread the word and help others as well. So on that note, all the best, and I'll catch up with you tomorrow. Bye for now.